Today, we're diving into the most interesting, unusual, and potentially game-changing opportunities in the stock market right now. Forget the overhyped headlines, these are the moves quietly catching the attention of smart money. And if you stay till the end, we're going to look at a sector most investors haven't even considered yet, that could explode over the next 24 months. Let's start with what might be one of the most misunderstood plays in the market, uranium. Yeah, I said it. Uranium. While everyone's been obsessed with AI and semiconductors, uranium prices have quietly doubled since 2020, and nuclear energy is making a full-blown comeback. Countries like France, Japan, and even the US are either restarting or extending nuclear reactors, while China is building more than 20 new ones. The world is realizing that if we want low-emission energy without relying solely on wind or solar, nuclear is essential. Global uranium supply is at a 15-year low. Spot prices just hit $100 a pound, a level we haven't seen since the early 2000s uranium bull run, when stocks like Cameco ran over 1,000%. So who benefits? First up, Cameco, CCJ. They're the second largest uranium producer in the world and already locked into long-term supply contracts with nuclear utilities. This is the blue chip of uranium. If you want a more explosive upside, check out Denison Mines, DNN, a smaller cap player with high-grade projects in the Athabasca Basin, one of the richest uranium regions globally. And for those who want exposure to pure uranium prices without mining risk, there's Sprott Physical Uranium Trust, SRUUF. It tracks the price of physical uranium and moves accordingly. High risk, high reward, but make no mistake, uranium isn't a trend, it's a comeback story in progress. Next, let's talk about small cap tech. The big players, Nvidia, Microsoft, Apple, they've led the rally. But underneath the surface, there's a massive divergence. Small cap tech stocks are still trading near their 2022 lows. And that's where things get interesting. Companies that have cleaned up their balance sheets, trimmed their burn rate, and are still growing at double-digit rates, are trading at dirt-cheap valuations. Start with SoundHound AI, SOUN, voice AI for cars, restaurants, and smart devices. They've locked in deals with Mercedes-Benz, Hyundai, and even fast food chains for voice ordering. Still under $1 billion in market cap. Then there's BigBear.ai, BBAI. They're building predictive AI tools for logistics, defense, and cybersecurity. This company was practically unknown a year ago, but they just secured a $900 million ceiling contract with the US Army. This isn't just hype, it's real revenue potential. We're talking about companies trading at 3x sales, while giants like Snowflake or Palantir are at 20x. If the market broadens out, this sector could rip. But now, let's get weird. Water rights. Yeah, water. Not tech, not crypto, just water. It's becoming one of the scarcest and most politically sensitive resources on the planet. Climate change, agriculture, and rapid urbanization are all putting pressure on global freshwater. And there are publicly traded companies already profiting from this scarcity. American Water Works, ORC, is a utility giant that provides clean water to over 14 million people. They're regulated, stable, and keep raising dividends. Then there's Xylem, XYL, a water tech company that builds smart meters, leak detection, and filtration systems for cities. Think of them as the plumbing behind the global water grid. And for something even more niche, Gladstone Land, a farmland REIT that invests in water-rich agricultural land in places like California and Arizona. They're not just buying crops, they're buying water access. There's even an ETF, CGW, it holds top global names in water treatment, utilities, and infrastructure. If water becomes the new oil, this is how you front-run the narrative. Next up, AI. But not the obvious plays. Forget the chips. The real opportunities lie in the infrastructure behind AI. AI data centers are energy monsters, some use the same amount of electricity as a small town. So what happens when demand skyrockets, and the grid can't handle it? That's where Vertiv Holdings, VRT, comes in. They build power and liquid cooling systems for data centers. They're already working with hyperscalers, and their revenue is exploding. Then there's Eaton, ETN, one of the most underappreciated names in electrical grid upgrades. They're positioning to be the backbone of energy delivery for AI and electrification alike. Schneider Electric, SBGSY, is another global beast quietly dominating smart energy management. They're like the invisible hand making sure AI data centers don't melt down. And don't overlook Arista Networks, ANET, the networking layer that moves trillions of bits of AI data every second. While everyone's talking about NVIDIA's chips, Arista makes sure that data moves. Now, onto something counterintuitive. Luxury stocks during an economic slowdown. It sounds ridiculous, until you realize that ultra-wealthy spending doesn't behave like the rest of the market. Ferrari, race, has a 2-year waiting list. They're not discounting, they're limiting supply, boosting margins, and growing their brand into the ultra-luxury space. LVMH, owns Louis Vuitton, Dior, Moet, and just posted record results in Asia. They're expanding in emerging markets and aggressively targeting the ultra-wealthy. Hermes, HESAY, is seeing the same trend. Their customers aren't just unaffected by recession, they're spending more. And the more the middle class gets squeezed, the more luxury consolidates into these mega brands. Now, let's get into what might be the wildest overlooked sector on this list: defense tech startups, going public. The geopolitical world is changing fast. Conflicts are rising. And governments are writing massive checks for next-gen defense tech. But the game is evolving. It's not just tanks and fighter jets anymore. It's autonomous drones, swarming AI, battlefield data analytics, cyber warfare algorithms. Already public? Kratos Defense, KTOS, is working on high-altitude drones and directed energy weapons. Leidos, LDOS, is a leader in cybersecurity and AI defense systems, working closely with the Pentagon and intelligence agencies. And of course, there's Palantir, PLTR, now profitable and growing both government and commercial contracts with real-world AI deployment. But keep your eyes on Anduril Industries, a private defense tech startup founded by Palmer Luckey, one of Palantir's co-founders. They're already getting massive military contracts and could go public through a SPAC or direct listing within the next 12 to 18 months. The bottom line? AI isn't just a consumer play. It's military infrastructure. And the companies building it are going to be huge. So let's recap: uranium, CCJ, DNN, SRUUF. Small cap AI, SOUN, BBAI. Water rights, ORC, XYL, land. AI infrastructure, VRT, ETN, ANET, SBGSY. Luxury goods, race, LVMUY, HESAY. Defense tech, KTOS, LDOS, PLTR. These aren't just themes, they're asymmetric opportunities hiding in plain sight. Which one are you watching? Or did we miss a sleeper pick you've been researching? Drop it in the comments, I read every single one. This is Legacy Analysis, where we don't chase hype. We predict it. Smash that like button if you learned something new. Subscribe if you want deep dive content with zero fluff, and we'll catch you in the next one.